Hey, welcome to the Darren Marcus podcast. This has been a lot of fun over the past few months. I've been doing this and honestly didn't really know where I'd go with it. The original concept behind all of this, and I've talked with a lot of you about it before, was that as we go into the recession and the market changes, people are panic. People start to panic. But I'm always reassured by entrepreneurs that I speak with that there's always opportunities in every market. And so that's what I've tried to bring with this show is I want to bring in people who have made incredible changes in their life, fought through adversity, went through downturns, and have come back stronger and better than ever before. And that's what the show is all about. And that's why I had named it Recession Busters, to really talk about the recession. But it's evolved into much more than that. And we're going to continue to grow the show. I've got some great guests coming up in the next few weeks. I've got Ivan Scher, who most of you are familiar with. He's the top luxury agent in the United States. We've got Pete Ruiz, who Pete has this incredible story. He's an artist. He was a concrete guy at one time. I was just telling the story prior that you would not have expected this from this guy, but he is a phenomenal artist. And now he's like well known throughout the NHL. He's doing all these stories and everything. I mean, not stories, but artist work with like different apparel and stuff like that. So anyway, let's get into the show today. What I wanted to talk to you a little bit about, and I've got a few questions here today that we've had submitted that I'm going to answer. So hopefully we can answer everyone's questions and talk a little bit about what's going on in the market, because that's probably the most common question. I had lunch yesterday with the editor for the RJ Millions, and she said, Darren, let me know like what's going on in the market. What are you seeing happen? And, obviously on different ends of the market, as far as price ranges, on the high end, we're seeing one thing, and on the lower price points, we're seeing another thing. I'm an eternal optimist, as we've always talked about, or I've always talked about. So I always try to see the bright side of things and where we're going and the optimistic side of it. Of course, it's easy to pick out the negative, and I think we see that on the news all day long. So I want to try to stay away from that and remain optimistic as possible, and hopefully bring you some good information. So let's just start with what I'm seeing overall in the market in general. Of course, 2022 has been challenging for a lot of agents, a lot of sellers and buyers. It's been a challenging market because for buyers in the first part of the year, you could make 20 offers on homes and you couldn't get one accepted. You could offer $100,000 over on a $900,000 home, waiving all contingencies and still not get it accepted. And so it was very challenging for buyers in the beginning of the year. And then things flipped for buyers, because not only was it challenging first just trying to find a home, but now all of a sudden, damn, interest rates have gone through the roof, right? So now I can't afford to buy anything anymore, or I can't afford to buy up. And so we saw a slowdown there. And I think just the pure fear of that sharp increase, because we saw the highest increase in interest rates that we've ever seen. But that's, of course, because we were also at the lowest point that we had ever been at, right? So we were seeing interest rates at 2.3 and 2.5. We've never seen that. And so, of course, we're going to have this sharp increase because at some point it's got to go back up. That being said, then we started to go into something else where inventory flooded the market, right? So now we have all this inventory come back on the market, but now there's no buyers because the interest rates are too high or they're panicked about the market. And I was telling the editor yesterday, I said, I think the thing that we also forget is that we had kind of this perfect storm of things that happen all at the same time. We saw the interest rates start to spike in April and May and June. June is traditionally a slow time of year for us, especially in the luxury market, June, July, August. So we saw this natural slowdown anyway that we would have we saw it in 2021, even when the market was hot. And then we had an election year. And one thing people forget is that during an election year, we always see a slowdown. And the one thing that I can say after 15 years in real estate is that even with that election, no matter what direction it goes, whether it's in favor of the person you wanted in or not, we always see the market come back. And that's what we immediately started to see in the last couple of months, that as interest rates have ticked back down a little bit, and as the people have now gotten over that, okay, this is the election and this is who's been voted in and this is what we're going to accept. Now people are going back and we're beginning to see people poke their heads back out in the market again. And I was sharing with somebody, I said, it's really, at the end of the day, the consumer drives it, right? The consumer makes the decision at what point they feel comfortable purchasing and at what point they feel comfortable selling. And it's just like at the end of the day, prices are dictated by what a buyer is willing to pay and what a seller is willing to sell it for. And that's really what it comes down to. And so that's who ultimately controls the market. So that's what I really try to look at. You can look at the stats, but of course, the stats are historical. That's telling you what happened last week, the week, the month before, over the past 3 months. And that's great information because that sometimes can help us forecast where we're going moving forward. But the one thing it doesn't tell us is what the consumer feels, right? And so if the consumer begins to feel confident again, or the consumer gets to that point where they're like, well, you know what? We've been wanting to move for the past 5 years, or our kids are moving out and it's now time to downsize, or we're transferring, we're moving to another state because we're in the military or our job's transferring us. And so there's all these things that start to come in, and then people start to poke their heads back out and say, well, you know what? I can't wait forever. At some point, I got to get back to living. And it reminds me of a story of back in 2009. I was actually bartending, and I'll never forget this. I met an economist, and of course, that's when we were going through our sharpest downturn. And I asked her, I said, hey, when do you think things will get back to normal? And her answer was the best. She said, Darren, as soon as people shut off that, which she pointed up to the news, she said, as soon as people shut off the news and they get back to living, that's when we'll see the economy rebound. And sure enough, as people got tired of the living in this downturn, and her explanation to me was, yes, we may have 10% unemployment. Keep in mind, that means 9 people are still working. That means 1 person is out of work. And I was like, wow, that's a really positive, optimistic way to look at it. And then we see the same thing with gas prices, right? Gas prices shoot up. They're $2, $2.25 a gallon. They shoot up to $5 a gallon. People panic. They quit buying. They quit driving. They're not going to drive anymore. They're going to buy electric cars. And then they realize the cost of electric cars, and now they're going to go back to driving. And then all of a sudden, when gas prices go back down to $3.99, people are really excited because there's been this sharp decrease. And so that's what I'm beginning to see again in the real estate market. As we know, there's always these ebbs and flows and ups and downs in any market. It doesn't matter what it is. I've worked in different sales industries. Every sales industry has its cycles. In fact, I think that real estate has longer cycles on both parts, longer in the good side, longer in the bad side. Other industries have these short little micro cycles where, in the beverage industry, it may be because it's wintertime, they slow down during that. But always in those times, there's always opportunities, and there's always people who are thinking, because everybody has to survive, how do we solve this problem for what we're seeing today? And so one of the lenders that I'd met with said, Darren, it's funny because people are acting like this is something that we haven't seen before, but we've seen this in the 80s. We saw it in the 90s. We saw it in the early 2000s, right after 9/11. We've had plenty of recessions that we've worked for, and people forget we just went through a recession just less than 2 years ago, right after COVID. We had this short recession that was 3 to 4 months, and then obviously things started to rebound, and we came back out of it bigger and stronger, and everybody forgot about the shutdown that we had for 6 months. So my opinion, what I'm starting to see is clients are poking their head back out, but what we're not expecting, and people haven't really talked about, is that we're going to begin to see an inventory shortage again. I've talked about this on a few other episodes where what's happening now is that people began to pull their house off the market, one, because they felt that they weren't going to get what they wanted, right? They were only putting it on the market because it was an opportunity for them to sell at the highest price ever and make a huge amount of money on the equity they had in the home. Once they realized they couldn't make that same amount of money, they pulled the home off the market, and they said, well, there's no buyers out there. And now what we're starting to see is a lot of people even renovate. So they're pulling, home equity line of credit out of their house. They're pulling this money out, and then now they're going to renovate the house. And when somebody does that, they're not going to be moving right away, right? They're going to be staying in that home for the next 2 to 3 years. On top of that, we have all these people that have refinanced or purchased in the last 2 years at a extremely low interest rate, 2.5%, 3%, right? You're not going to see that anymore, right? We're not going to probably see that again ever. And so the chances that those people are now going to sell their home is going to be very unlikely, at least in the short term, right? Maybe 10 years down the road, they will. So what that means is our inventory is going to continue to shrink. The other thing is that the builders, they don't want to get back in the same situation they ran into 2008. So what did they do? They immediately put their foot on the brakes, and they've stopped construction, and they quit building. So that means there's no new inventory being created. But there's still this demand for Las Vegas. People are still moving here. We have Californians that are still coming to our market. That we know the tax laws and everything else in California is not going to change anytime soon. So Nevada is looking better and better and better all the time for people from Southern California. So we're going to continue to have this influx of buyers coming into the market, yet inventory getting tighter and tighter and tighter. And I'd been talking about that since summer. Starting in like end of November, we began to see this depletion of inventory for several reasons. One is also holidays, but the inventory is depleting 10% a week. It's coming down, getting lower and lower and lower. And now we go into the first part of the year. Of course, you'll see a little bit of an uptick because those people that had pulled it off the market during the holidays now going back on the market for a short time. But we're going to see that inventory continue to shrink down. And what we're going to do is I think we're going to be back in this situation like we were similar to last year, not at the height that we were last year, but we're going to see this, even if the interest rates get back down to in the fives, right, which we're already seeing on these 5-year ARMs and everything else, the interest rates are back down in the fours. Once consumers realize that interest rates are back down in the fives, they're going to jump on that because they're going to think, shit, I'm not going to take any chance of this interest rate going back up. And there's less buyers out in the market. So there's this opportunity right now for me to get out there as a buyer and purchase a home. And so I think we will see this upswing again, starting in like probably mid-February. I can tell you what I'm seeing on the ground in real time is that activity is already picking up. We're starting to see across the board on all of our listings, activity is picking up. And so I'm very optimistic about what we're going to see over the next 6 months going into 2023 with the housing market. And I think that we'll continue to see interest rates come down, even if it's slow, and we'll continue to see that inventory deplete, which leads us to something else, is that now that means that those prices will start to rebound, right? So that the pricing on these homes will start to go back up. And because our inventory is low, yes, you may have less buyers, but it's going to put sellers back in a good position from negotiating. So, buyers I talked to today, I'm like, it's actually still a decent time to buy because there's so many different loan programs out there too, where you can get a temporary low interest rate. And then as that interest rate starts to go down, then you can refinance at that lower interest rate, but now you're in your home and less competition. So I'm seeing really positive things for first quarter and an uptick in our real estate market again. Let's talk about the luxury market and the difference in what we're seeing in the luxury versus the lower price points. So, of course, the lower price points have come to a screeching halt because those were the clients that were the most impacted by the increase in interest rates. It either pushed them out of the market to where they could no longer afford to purchase a home, push them back into renting or staying where they were renting at. And the people that were looking to buy up, which is now why we've seen that $1 million to $2 million price range really be impacted, because 50% of those homes that were purchased last year between 1 to 2 million, those were loans. And so those were buyers who were selling their homes and they were buying up. And so that's why we saw a huge increase, right? It might've been somebody who had an $800,000 house. They sold it. They'd only purchased it for $500,000. They had $300,000 in equity. Now they can get a 2.5% interest rate. They're putting $300,000 down. Now they're buying a $1.2, $1.3 million home. And that's why we saw that part of it pick up. We also saw the sharp decrease in that price range, right? I mean, almost over 50% drop in the purchases of homes between 1 to 2 million. Now, keep in mind, we also saw this sharp increase. So of course, we're going to have a sharp decrease, right? When the market shifts. The 2 million plus market, that's where this really starts to get interesting because we are not seeing huge changes in that market. And where we are seeing, as you get higher up into the ultra luxury, and I consider ultra luxury, we'll just call it 5 million plus. But as I looked at the stats from last year, the 3 to 5 million price range, we were actually 2 less units less than we were. And I looked at these numbers for September, October, November. And we'd only sold 2 less units this year than what we had sold in 2021. And then when you look at 5 million plus, we were 8 units less. 80% of those on the 5 million plus being loans. I'm sorry, 80% being cash. The 3 to 5 million, it was about 60% that were cash. Now keep in mind, the big reason too why those were cash last year was that it was cheap money, right? And so anybody who could qualify for a loan, why would they pull their money out of the market that was making them money as the market was increasing, or they've got their money in other investments that's making them a higher return. And so why would they pull that money out when they get a loan from their bank and leverage their bank's money at 2.5 or 3%? So that's why you saw a lot of loans last year. We're still seeing those luxury buyers come back because things are not changing in the states that they're coming from a tax standpoint. And so now they're starting to come back and we're seeing an uptick in that market again. The big difference this year and why some of those sales are down, and you can see it when you look in the MLS, is that what people are not thinking about is that last year we had a lot of inventory, even off market. We had a lot of sellers that were willing to sell. They just didn't want to put their home in the MLS. That's one thing that doesn't get accounted for, is that when you start to get into the ultra luxury, 3 million, 5 million, 7 million, all those price points, a lot of those sellers keep the home off the market. They'll still show it, they'll still sell it, but you don't see that inventory on the market. The other thing is we saw standing inventory has dropped on the high-end luxury. If you look at the numbers still may remain the same or close to when you look in the MLS as far as the actual numbers there, but you have to start looking through those and really understanding that a lot of what you are seeing is they're what we like to call a virtual spec. So I give you an example. I had a client a few months ago now, they were looking between $4 to $7 million. And we looked in McDonald Highlands. There were 22 homes available in that price range that fit the criteria that they wanted. And then when we narrowed it down, there were 15 of those were new construction. Okay. 7 of those were standing inventory, 5 that were very dated and need renovations, and 2 that were brand new homes that were priced super high per square foot that didn't make sense for them at the time to purchase. And they were really shocked when they even said to me, Darren, please send me everything in this price range. I said, I did. I literally sent you everything, even things that weren't within your criteria for you to take a look at, because I really think that you need to see everything that's out there. And they were shocked on how low that inventory is. And so that's the one thing that I think that we're not factoring into this as we see the drop in luxury home sales, is that the desired inventory that was out there in 2021 and early part of 2022 is no longer there, and that's shrinking. The inventory that's there, that's good, is getting a lot of activity. And I share that because I've got listings that are from 350,000 up to 7 million. And I will tell you, in firsthand experience and seeing what we see, I get more activity on my $7 million listing right now than I do on any other price point. As far as the market crashing, I don't think there's any chances of that. And the one reason is because we've got so much equity in these homes. The last stat that I heard, that I think it was 83% of homeowners in this market have 6 figures or more in equity in their home. Nobody's walking away from that. Also, the difference between 2008 and now, obviously, is the type of loans that are being given out, right? They had these 100% loan programs back in 2008, where I'm a bartender making $60,000 a year, and I qualify for 5 loans because I can go get those from 5 different lenders, and I can qualify for an 80-20, get 100% down, not have to come out of any money out of pocket, and be a wannabe investor and own these rentals. And then all of a sudden, what happens is when that market takes a slight shift and those renters move out, I can no longer afford to make those mortgage payments anymore. And that's where we saw the people default, or people were so far upside down, they just said, screw it, I'm $100,000 upside down in this house, the bank can have it back. We're not seeing that in this market. So that's the main thing for me. That's a leading indicator that we will see the market continue to stay stable and rebound, is the fact that you don't have these super low or you don't have these crazy loans on these homes. People have got a ton of equity in them. And a lot of these people have put anywhere between, I think I'm seeing right now is the average down is 8.5%. So let's just even call it 10%. You're buying a $500,000 home, you're putting $50,000 of your hard-earned money down, right? You're not walking away from that. And that's one thing to keep in mind. So I think with the luxury market, what we're going to see over the next few years is that it will continue to stay stable because of those California buyers coming in. It'll continue to, we'll see that inventory continue to shrink because there's no new homes being built. Because also as prices and supply chain skyrocketed, or supply chain got tightened and prices skyrocketed, people also put their foot on the brakes with building, right? So now there's no new homes being built, but there's still this demand that's coming in. And at some point that's going to snowball and we're going to be back in this housing shortage again, like we saw before. On the lower price points, I think we're going to see the same thing because you're not getting the new home builders that are building. You're getting people that are pulling their home off the market. You've got people that are in at 2.5% and 3% interest rates that are not going to have any plans to sell anytime soon because they're not going to see that interest rate again. And so believe it or not, I think in the next year, for sure, and then a major shortage in the next 3 to 5 years on those lower price points and more affordable housing for the everyday consumer out there. So that's what I'm seeing.